Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is April the 24th, and we have Brent crude oil. Little change this morning in Asian trading at about $88.50 as we come to the end of April. Quite a month, one would have to say it has been. We started off April 1st with the now infamous attack, the Israeli attack on the Iran consulate facilities in Damascus. We end the month with the US about to pass even further sanctions on Iranian oil, buried inside this fairly substantial US bill that President Biden is due to sign today, which apparently also includes the banning of TikTok. So lots in it. Robin Mills, CEO of Camor Energy, given the month that's in it, Robin, and all that's happened in the interim since April 1st, has anything substantially changed in the region that geopolitical premium analysis isn't accounting for, or is the premium deflation accurate in your point of view?
Well, I think as you laid out, Sean, a lot of things have changed, but fundamentally, does that put us in a different position? I think as the oil price is telling us, we're not in a very different position despite all these developments, particularly in the Iran-Israel conflict. And I think that remains as a tail risk, a very serious one, but a kind of, low probability, high impact event. And you see that to some extent in options. And, there have been some buying of very high priced options, but it doesn't really affect the flat price overall because people think largely it's been contained. The two sides have signaled some restraint, or at least Iran's kind of signaled restraint, and US has signaled that it will restrain Israel to the extent that it can.
Arn Lohmann Rasmussen, Chief Analyst and Head of Research at Global Risk Management. Same thoughts to you, Arn. I mean, ultimately, we've seen somewhat counterintuitively since the Israel attacks Iran's consulate and the sort of retaliations of that the oil prices actually declined. I would imagine if you had asked anybody in this room and everyone else that comes every day that question on March 31st, what would happen if this happens in April? I doubt there'd be 1% of the group that would say prices will fall. What would we have not been seeing on April or on March 31st that accounts for this deflation?
I think if you have told me that Iran would send 300 missiles and drones towards Israel, of course we would have said prices would be higher. But I actually think that there's been some kind of de-escalation here, right? That yes, they did this, but apparently they knew that most of them would be taken out. The Israeli counterattack was relatively modest, so maybe we're actually in a situation. Okay, if this didn't end up in the outright war, then it's not hopefully not going to happen at all. Then we can actually start pricing out the geopolitical risk premium or the war premium and whatever you're calling. And I see a lot of people discussing what is then this geopolitical premium. So Bloomberg, I think yesterday saying was $25. So if that is the case, of course, then we should go lower. I would beg to differ of the $25 bar, by the way. This is a very simple approach to measuring the geopolitical premium. But yes, there's actually, in a weird way, some kind of de-escalation because the risk of an outright conflict actually seems to be lower now. If this couldn't trigger the conflict, what can then actually trigger the conflict?
It certainly feels that way, that this might be the sort of the exclamation point in all of the questions of the last 6 months. Will Iran-Israel be dragged into a wider regional war, or would ultimately the US be dragged into this war? And I think probably that's the most significant outcome of events recently, was that call between Biden and Netanyahu saying, we're not joining you in any event, retaliation. I think that was probably the most influential statement of the last 6 months by the US president. Finally, clear.
I think it's fair to say that anything that risks pushing up gasoline prices ahead of the election, Biden will not do that. I don't think you need to be a PhD in geopolitics to see that. And I think this is a good example of this. the pressure on Ukraine not to attack Russian refineries. Another example of this, of course. So I think we have to see it in light of this. It's a bit cynical, but that's the way it is.
Alan Gelder, Downstream Global VP Refining, Chemicals and Oil Markets, Commodities Research at Wood Mackenzie. Geez, you've got a long.
It's a big job,
Alan.
Take a big breath.
I hope you're getting paid for all of those 3 or 4 hats.
I hope we're recording this. Thanks, mate.
It's like, we keep getting added on hats, and somehow the comp doesn't change. That's the nature of the modern world, isn't it? But meanwhile, Alan, back at the ranch, so to speak, of the basic fundamentals of oil supply and demand and the old-fashioned crude oil inventories, we're seeing reports out of Reuters that U.S. crude oil inventories fell over 3 million barrels of the week ending April 19th, according to the American Petroleum Institute. And yet prices aren't even reacting to that. Where do we see the fundamentals of inventories, do you think, on this market direction?
At the moment, they're probably at a bit of a turning point if we look at them globally, because we're tracking global commercial inventories, classic weekly basis, and they're still on a weekly basis creeping up very small amounts over recent weeks. But in our numbers for that week finishing Friday the 19th, we're down. The US Cushing's down 1.2 million barrels. So you've got, since what we're starting to see is effectively a turn in those crude inventories, with the expectation we've got for the second half of the year is the inventories draw, and that supports pricing. We get some more OPEC barrels back in the market, but we've got effectively market tightness, and we're at this quandary now of what are you measuring? Are you measuring global? Or are you looking at US? They're not all aligned yet, but we think we're probably at that turning point as we get into the second half of the year, where we'll start to see some probably fairly significant draws if our analysis, the fundamentals, prevails, which is fairly strong demand growth. We're probably above consensus on that, and then OPEC being slow in returning barrels to the market.
Robin, if we look at this bill that's going through the U.S. government this week, finally, from obviously a Ukraine perspective in particular, the U.S. Senate has approved what the House approved earlier this week, a $95 billion aid package, most of it for Ukraine. But buried inside it is even more targeted sanctions on Iranian oil exports. Your thoughts on those further sanctions, what they may mean? Will they have an impact? We've seen the existing ones, and my goodness, you could fill a room with the amount of sanctions that are on Iran at this point. Will these additional ones make a change to what appears to be Iran exporting as much oil as it can?
Yeah, sure. I just want to address one point before I go on that, Sean, which is on the Ukrainian side, because you mentioned the attacks on refineries, and that was, I think, designed exactly to put pressure on the US and say, look, we're not getting weapons, we have to strike back somehow in a way that may be politically uncomfortable for President Biden. So that's a further incentive for him to pass that package on weapons supplies, which is, of course, through a change of heart of the Republicans has now happened. But on the Iranian side, all these new sanctions designations, I see these really as pretty symbolic. This doesn't really give Biden any new sanctions powers that he didn't already have. Look, I think that the Iranian oil exports have risen very significantly over the past couple of years, and particularly since early last year. And that is down not to any kind of lack of sanctions authorities, but it's down to two things. Firstly is enforcement. And secondly is greater Iranian skill in avoiding sanctions. They're using new tactics, spoofing positions of vessels, expanding ship-to-ship transfers, all this kind of stuff. And on the US side, the people who basically a couple of years ago were only doing Iranian sanctions now spend 90% of their time doing Russian sanctions. So the focus isn't so much there. So when the Iranians do devise a new tactic of getting around these sanctions, there isn't a kind of corresponding counter response on the US side to close off that avenue. And it's getting increasingly difficult for the US. China is basically the only buyer now. And the US-China relationship perhaps has improved a little bit recently, but it's not very good, and difficult for the US to move very aggressively against China right now and try and put secondary sanctions on big Chinese companies and so on. So no, I don't think this really makes any significant difference. But if the US were to step up enforcement, yes, that could have an effect.
Yeah, you'd probably see that in the oil price if indeed we saw some real sort of engagement, interdictions, as they used to call it, of ships coming out of Iran. Arne, your thoughts, just picking up on that earlier comment Robin mentioned, which of course is buried also in this bill, is $60 billion for Ukraine's war effort, and the US government, the Pentagon, very quickly saying that they're going to be able to deliver weapons within days. I'm wondering, is that bearish or bullish for oil prices that suddenly Ukraine are going to have a whole big bunch of new weapons?
So far, I think it is bearish, especially for some of the distillates. We're seeing ice gas oil, for example. Cracks are coming off quite significantly there. The curve has moved into contango, the ice gas oil curve, and I think that is the reflection, as Robin said, that yes, Ukraine probably used this as a kind of a pressure on the Biden administration. We can fight back on global prices if you don't deliver. So I think the Ukrainians will use their new firepower towards more power production in Russia, things related to the army, not that much related to the refinery industry. So I think they will use them wisely in that respect. So in that way, it is in a way bearish for distillates, and you can say also bearish for crude oil, because there is probably some damage to Russian infrastructure, refinery infrastructure. That will mean that they will need to deliver more crude oil to the global market. I think one thing that would be quite interesting to follow here is that when will the Saudis try to put some pressure on Russia to also cut back on exports? I saw the latest shipment numbers by sea. They were basically unchanged. It doesn't seem like Russia is doing anything to cutting back on crude oil export. I think there's a brewing a conflict here in the OPEC Plus, but so far, of course, they're quite successfully with prices close to $90. But overall, probably slightly to the bearish side, I would say. If they start attacking the shipment, the harbors, the port facilities, and so on, then it would be bullish. But I don't think it will happen.
Alan, just picking up on that as well, your outlook, Russian crude exports seem to continue to flow, particularly related to the Baltics. What is your outlook there?
The outlook is broadly, well, if we look back at what we've seen was a bit of a surge in exports in April because of unplanned refinery maintenance or impact of drones. Is fairly unclear as to what it was, but what we're seeing is sort of sustained significant crude flows back up at those range-bound levels. We've seen return to distillate exports. So the Russian energy infrastructure seems to be back to normal. The slightly extended maintenance if we're aggregating it, but we're seeing recovery in activities, and it kind of goes to Arne's point actually, in the, well, I can say Robin's raised it with Arne around plea for help. If the Ukraine wanted to impact Russian energy infrastructure, it would do it on the ports and the berths, on the loading facilities. It's consciously not done that. So sort of a plea for funding. So now they've got artillery shells. Where might their drone capabilities be best utilized? Probably not on sort of refining in any energy infrastructure, given the US funding. But there is that brewing tension between OPEC Plus on compliance with these lower numbers, so the lower requirements. So how will that be managed? Probably quiet diplomatic channels between Saudi Arabia and Russia. There's probably discussions underway as to exactly what, how, and Russian compliance seems to be largely achieved in hindsight. They sort of declare how they have achieved what they've met. So there will no doubt be some tension there, but with the market we've got tightening during the rest of this year, maybe that will smooth over those discussions.
Robin, just picking up on that, I mean, OPEC plus, they seem to be in the Goldilocks sweet spot for whatever multitude of reasons. Brent crude oil at knocking on the door of 90 or certainly in the high 80s seems to be everybody's happy place. Your thoughts on some of those tensions highlighted by the two others on OPEC and Russia, Saudi relations at this point, going, 5-6 weeks before the next big meeting?
Yes, I think as you say, Goldilocks at the moment. I think there'll still be a concern. Russian compliance is not perfect, and as Alan says, it's declared retrospectively. And I think the refinery attacks, the repairs are going on, and you would think, as Anna says, that will push out more crude. But is Russia going to hit some limits on the amount of crude it can export, at least in the short term? And I think maybe not at this level, but if there were further refinery attacks, it might start getting constrained on crude exports. But that would help the whole project of OPEC plus compliance, of course, if it had to cut back production. But I think at the moment that's manageable. There are obviously several other OPEC members who are under complying, and particularly Iraq, and in non-OPEC Kazakhstan. I think there'll be obviously at the next meeting more Saudi pressure to say to them, you need to do more. I don't expect Iraq to retrospectively comply or to cut back production to compensate, but it probably will get a bit closer to at least complying on a forward basis. But those tensions are still manageable, particularly while crude, as you say, is hovering around 90. If it were to fall, of course, those tensions would be highlighted again. But at the moment, is 90 enough pressure to start easing the cuts? I think it won't until we start getting closer to 100. Then the OPEC countries will think about it. Maybe it's time to start gradually bringing back some of particularly the voluntary cuts.
Arne, just on that, where do other risks come from? If we've, in this course of 20 minutes here, sort of defanged the geopolitical risk between the two major sources of the Israeli invasion of Gaza, and the Iran ramifications of that have been diffused. The bearish elements of this new military aid bill to Ukraine is bearish. Are there any other risks out there that you think that we're not looking at the moment? I mean, that it seems both the Straits of or the Red Sea disruption and the Suez Canal disruption and the Panama Canal are also easing as choke points. Your thoughts on any other risks out there?
Of course, the sort of elephant in the room here is, of course, an outright trade war between China and the US, but it's probably more of a medium-term risk. Short term, I think we have enough risk with these two things, so I stick with that. But basically, there's also a twist around this, because maybe we're pricing out a bit of the risk premium now, the geopolitical risk premium now, but it actually makes it much more likely that the OPEC Plus will extend their production cuts into Q3 and Q4. Imagine we have been trading 95 or 100 due to an elevated risk premium during May. There will be a lot of pressure on OPEC to say, okay, then we cannot extend the production cut. It doesn't make any sense. Now we're trading at this high 80s, 90 level. I think they will roll over the cuts, because they were saying that this is there's still some risk premium in the market. Inventories has been going up in Q2, so we roll over the production cuts. If there has been an elevated risk premium, they would have been forced to sort of roll some of that back. I think that is actually the twist to hold this geopolitical premium discussion. But I cannot really pinpoint any, and I'm glad I can't, any sort of third.
Well, there's none of those real kind of bullish elements that seem to be very present only a few weeks ago, where that real upward momentum, where we broke out of the sort of high 70s, low 80s range, and we moved to 90 with the all of the elements being somewhat bullish. Let's go to the survey question and get the view of the room wider on this point of the US bill passing through Ukraine, 60 billion, and the Pentagon says it could start delivering weapons to Kiev within days. Is this bearish or bullish for oil prices? a bigger war in Europe sounds to me like that's a bullish thing. If you got bigger guns and bigger bang, and there was a lot of sort of geopolitical forecasting that Russia was going to do a big surge this summer. If indeed that meets up against a rejuvenated Ukrainian weaponry, then is that more bullish than bearish? So welcome the views of the room on that as to where we think that may be going. Alan, it does seem that despite all of these things, that Russian diesel, gas, oil flows, we saw rise sharply last week. Doesn't seem to be anything disrupting that, even with these refinery outages. Your thoughts on the outlook for Russian diesel, gas, oil flows?
We have them remaining pretty strong, and in terms of, we see with this aid bill being passed that Ukrainian attacks on Russian refineries will ease, so that will keep them running strongly. There is the need for more Russian gasoline during the summer because there's more travel within Russia because they're not flying as much to other places. So that keeps runs high, which means Russian diesel exports remain pretty strong. And they're going to this whole new trade routes, isn't it? With Brazil being the predominant buyer of those molecules. So we, having seen a lot of strength in diesel cracks earlier in the year, we kind of not really got them recovering very much because the European economy is pretty weak, not a great deal of demand. And you mentioned the Red Sea, and we've got sort of one third of east to west traffic is still going by the Red Sea. That means 2/3 is going round, but we're not really seeing that in elevated cracks. We think the world's probably got enough diesel. It's gasoline that's going to drive things in the shorter term. Refining staying reasonably tight, and then a lot will come. In terms of global markets around gasoline, the products, a lot of it is based on what happens to the start of Dangote in West Africa. But we've got diesel. It's a diesel-led world, but not quite so strongly as prior years as the economy rebalances a bit, and we've got more capacity coming on. But we're expecting fairly sustained flows of Russian middle distillates.
And its destination?
Everywhere other than Europe. So North Africa, bits of West Africa, down into Brazil. Depending on the pricing, we've seen bits go into the Middle East and people do a bit of trade arbitrage. Turkey's a major buyer. So there's an awful lot of sanctions arbitrage that's happened and happening. We kind of the money talks, and we expect that to continue.
Robin, the other big development this month has been the sudden realization that actually the Fed may not cut rates this year, and the price of money might remain higher for longer. Your outlook for that at the end of April and its ramifications for the oil markets?
Yes, that's well, we've been around the roundabout on this one. I think if anything, we might be kind of starting to tilt back to perhaps there will be a rate cut. Just some hints, that the US economy might be slowing a bit, and there might be some room for a rate cut later in the year. But still reading the tea leaves on that one. It would obviously be, if there is, obviously be supportive. But I think also moving towards a rate cut in the UK and Europe, in the Eurozone, which would be supportive there. Perhaps things finally looking up in the European and UK economy. So those are a couple of things I think that are kind of mildly bullish potentially. So still, I wouldn't say there's a dramatic change in expectations there, but maybe just some early hints.
But if we just take that a little forward, Robin, from the point of view of the corporates, I mean, we were expecting the equity markets were rallying on the back of the fact that we were going to have mega rate cuts this year. And now they seem to have found new reasons to rally. But the idea that the price of money would stay high for longer, what that would mean for the majors, the oil majors, and their willingness to put money in the ground for new capacity. Your thoughts on the impact there, or is there one?
I think for them it's more about I mean, partly about the price outlook, but even more so about the opportunity set and about cash flows. Cash flow is very strong, and then mostly going to shareholders, but there's always some left over for new investment. But the opportunity set is the question for the US companies. The opportunity set is very good, right? If you think about the biggest US companies in shale and Guyana, you know, the big two for them, or acquisitions, and they've gone down both of those roads. For the European majors, much more constrained opportunity set. LNG is an obvious one. You know, Shell particularly, and we've seen the chat about Shell and Total being interested in the Abu Dhabi new LNG plant. Absolutely expect that they would be. And they have a couple longer term. They have some major discoveries to develop, perhaps places like Namibia. But in the near term, you know, the opportunity set for them is a bit constrained. Does more of that then go into their green energy business? Well, you know, we've seen plenty of discussion of that they've been having a hard time really making that work, and higher interest rates, even if they come off a bit, you know, but we know that higher interest rates have been quite negative for investment in the renewable sector.
Aaron, just picking up on that, we are seeing that reports, U.S. single-family home data showing a rebound in March. The U.S. economy remains buoyant. We started the year with the forecast of 7 rate cuts this year. As we go deeper into second quarters, there's even some mention now by the likes of the Larry Summers and others that you have to even consider the possibility of a rate hike still being in the oven. Your thoughts on where rates intersect with the outlook for oil markets in the second half of the year?
Yeah, it's secondly been a turnaround. We're actually in a kind of a strange situation now where we have like slightly weak numbers, like we saw yesterday with the PMI going down in the US. It's actually bullish for sentiment, risk sentiment, and also drag oil along. But a bit strange that weak numbers are positive, but that's because we're trading on the Fed. I think that inflation is actually coming off, that we will see a rate cut later in the year, but we are in this higher for longer. I'm not in the Larry Summers camp. I actually heard him last week in Copenhagen. He has really turned from the secular downtrend to being very hawkish. But yes, I think there will be slight rate cuts. It will be supportive for the global economy. So that's how I see it. Another thing I think is quite interesting is that the higher for longer narrative is actually, as I see it now, triggering some asset allocations that can be a bit tough to grip if you're very focused on the energy market, because these are asset manager hedge funds that could be active in various assets. And I think we are seeing a tendency at the moment that they are sort of switching into, for example, commodities, energy, and so on, things that actually benefit from growth here today, and moving away a bit from the, of course, duration bets. Duration bets is tech stocks, bonds, of course, IT stocks, AI, and so on, things that will benefit from lower interest rates. And I think we should be careful not to underestimate this. And I think it also have a lot of impact on, for example, on spreads, because these guys are moving into Brent oil, WTI, because they are moving into the very liquid stuff. That's going to actually be a reason why we are seeing these, that the Brent curve is still very much in backwardation. We're seeing the products being under pressure. It is, of course, a fundamental reason, but it's also these flows. We keep a close eye on those, but it also means that if we see negative data, the impact on the downside can be sizable. I hope that made what's clear.
Alan, last word for you. I wanted to get your insights on it. We've talked obviously about Russia and the Western markets and so forth, but where are the Chinese refiners now? The throughput there, we've seen pretty solid crude oil import numbers into China in the first quarter. Nothing stellar, but ultimately still holding a kind of an average, if you like. Where is that translating in throughput for Asian refiners, for Chinese and their exports of products?
Oh, no, Sean, it's a good question. We've seen China importing significant volumes, the classic first half of the year sort of inventory build that then largely gets processed through the year. We've had fairly strong Chinese GDP growth, but it's been a particular sector rather than the broader construction, and so we're looking at Chinese runs remaining reasonably high, and sort of the next set of export quotas coming out. So Asian runs remaining fairly high, and volumes continuing to come out of China. So we need to see how that plays out, but it's going to basically keep a lid on Asian refining margins, keep them relatively suppressed, because we're expecting a fair amount of activity in China. The diesel demand, we've got very limited growth, so we've got fairly strong exports from China for the remainder of this year, and that'll just suppress Asian refining margins.
Well, we wrap it up there with Brent crude oil and all in the energy, at least hydrocarbon value chain. Everything is showing green on the board this morning. Brent at 83.60 or 88.74, WTI at 83.66. Natural gas is also up a little bit, although obviously still very low in terms of NYMEX. And then all the distillates are looking up as well. So it's a green day for energy, for oil and gas. We'll see if that holds, if there's new momentum. Some people saying that obviously the recent correction in crude is a consolidation at these levels before going to the next high, with the second half of the year expected to be quite tight, particularly if we see a rollover by OPEC Plus when they meet in early June. That could be another momentum. But at the moment, it looks like geopolitical risk is deflating the balloon, and we'll see if that sustains. Robin Mills in Dubai, thank you as always. Great to have your insights and contribution today. Thank you so much, as well as Arne Lohmann Rasmussen in Denmark. Really great to have your contribution today. And Alan Gelder in the UK. Thank you so much, Alan, for joining us. All the best, everybody. We'll catch up with you again every morning, 10:30 UAE time. Thank you.
Cheers, guys. Enjoy the rest of your day. Thank you.
Thank you.
Cheers.
Thank you.
Bye-bye.